6 assets you need to sell before the dollar reset. Most people are about to get wiped out. Not because of bad luck. Not because of a market crash nobody saw coming. Because they are holding the wrong assets at exactly the wrong time. And nobody in their financial life has the guts to tell them. Today, I am going to tell you. There are 6 specific assets that become dangerous in a dollar reset. Most people hold at least 3 of them right now. Some people hold all 6. And the terrifying part is, they feel safe. That is the trap. Here is the one thing I need you to understand before we get into the list. A dollar reset does not mean the dollar disappears overnight. It means the dollar quietly loses purchasing power, faster than your assets can keep up. And when that happens, assets that look stable on paper become wealth destroyers in real life. The number stays the same. The value underneath it collapses. That is the mechanism. Now here is where it shows up in your portfolio. Asset number 1, long-term government bonds. Most people think bonds are safety. Turns out, in a dollar reset, long-term bonds might be the most dangerous thing you can hold. Here is why. When the government inflates away its debt, the bondholders take the hit. That is you. A 30-year treasury promises to pay you back in future dollars. But if those future dollars are worth 40% less, you handed someone a loan and got back a fraction of what you put in. The check clears. Your purchasing power does not. And here is the signal nobody is talking about. Foreign central banks, the biggest buyers of US debt, have been quietly walking away. China selling, Japan trimming. When the institutions that used to absorb all that debt stop showing up, something has changed. Pay attention to that. Short-duration instruments give you flexibility. Long-duration bonds in this environment give you slow-motion losses dressed up as safety. But that is not even the most dangerous one on this list. This next one is hiding in plain sight. Asset number 2. Excess cash sitting in your bank account. Not your emergency fund. Not your operating capital. The excess. The pile you built because it felt responsible. Here is the cold math. Inflation at 8%. Savings account at 1%. You are losing 7% of your purchasing power every single year without a single dramatic event. No crash, no headline. Just slow, silent erosion, compounding against you every month. Actually, this is the most insidious one on the list, because it feels like the responsible move. Keeping cash feels safe. Turns out, in a devaluation environment, cash is just a slow bleed with a savings account wrapper around it. Keep 6 to 12 months of expenses liquid. Everything above that needs to be working harder than a bank account that pays you nothing. Most people fix those 2 and think they are done. But this next one is where the real exposure hides. Asset number 3. Overvalued growth stocks with no real earnings. Cheap money created a fantasy. When interest rates are near zero, investors are willing to pay enormous prices for promises of future profits because the cost of waiting is low. Speculative growth stocks exploded in value not because of what they earned, but because of what they might earn someday. Turns out, that math completely breaks when the environment changes. When a dollar reset hits and rates rise, the discount rate goes up. And when the discount rate goes up, those far-off future earnings are worth almost nothing today. We already saw the preview in 2022. The most hyped names dropped 50, 60, 70, 80%. In a full reset scenario, that pressure is more intense and more sustained. The move is not to dump every tech stock you own. The move is to be brutally honest about which ones have real earnings and pricing power right now, and which ones are pure monetary policy bets. Now here is what nobody in finance is telling you. Because this next one catches the people who thought they were the smart ones. Asset number 4. Variable rate real estate in overheated markets. Real estate feels like the obvious inflation hedge. And with fixed-rate financing it can be. Your debt inflates away while your asset holds value. That is a genuinely strong position. Except, if your property runs on variable-rate debt or short-term financing that needs to be rolled over regularly, you are exposed in exactly the wrong direction. In a reset scenario with rising rates, your financing costs spike at the exact same moment overheated property values start correcting. High costs, falling values, both happening at once. Run the honest calculation. Strip out price appreciation entirely. Does this property generate enough rental income to justify what you paid for it? If the answer is no, and the debt is variable, that is a position worth addressing now, not later. Asset number 5. Fixed dollar annuities and life insurance with fixed payouts. This one is quiet. And it hits the people who did everything their advisor told them to do. A fixed annuity promises a specific dollar amount every month. That sounds like security. Turns out, it is a guarantee of dollars, not a guarantee of purchasing power. If the dollar loses 40% of its purchasing power over the next decade, your $3,000 monthly check becomes the real-world equivalent of $1,800 in today's money. The insurance company honored the contract perfectly. You still lost. Check your products right now. Do they have inflation adjustment features? Many do not. If yours does not, you have a gap in your plan that needs to be addressed somewhere else. Asset number 6. Diversifying into other paper currencies. This one sounds like the solution. It is not. Moving dollars into euros, yen or pounds feels like diversification, except you have not left the paper currency category. You have just picked a different government's monetary policy to bet on. The euro has structural debt problems baked in. Japan carries one of the highest debt to GDP ratios on Earth. Most emerging market currencies are even more fragile. Instead of paper-to-paper diversification, the meaningful move is out of paper currencies entirely, into assets with intrinsic value that no government can print away. Physical gold, silver, real productive assets. Companies with pricing power and hard assets behind them. That is the distinction that actually protects you. Here is the bottom line. Most people's entire financial life is a concentrated bet on dollar stability. Their cash is in dollars. Their bonds pay out in dollars. Their annuity is in dollars. Their life insurance is in dollars. That is not a diversified portfolio. That is a single trade with a lot of different labels on it. Turns out, the risk was never about having the wrong stocks. It was about never questioning the dollar underneath all of them. Now you are questioning it. That puts you ahead of almost everyone. If this opened your eyes, hit that like button right now, before you scroll. Most people will watch this and do nothing. Do not be that person. Subscribe to Outlaw Wisdom. This is the channel that tells you what the financial industry hopes you never figure out. New video every week. No fluff, no sugarcoating, just the truth about your money. Hit subscribe. Tell a friend. And come back next week. Because what we cover next might matter even more than this. Stay wise, stay free, and keep your wealth where they cannot touch it.